I'll be talking in more detail about the trades that we're doing in the portfolios. We've just had our latest quarterly rebalance and we've implemented a change there. So I will talk about that at the end before we open up for Q&A. So without further ado, we'll go on to the first section, which is mine just on markets. And if we go to the next slide, there we are. This shows the performance of major asset classes. I've gone year to date to put it in context, but you can see there's a dotted line that shows where we were, where markets were when we last met. And really what we've seen over the summer since that last meeting, momentum in equity markets has largely continued. It has stalled in the last few weeks, and I'll touch on that in a second. But you can see that dark blue line there is developed market equities, and they've generally continued to move ever steadily higher. Gold has largely gone sideways, but it has kept hold of those gains we saw from earlier in the year. So actually gold's had a pretty solid year and is managing to hold on to that positive movement. And you can see at the very bottom line there in teal, a light and a dark version, but these are bonds. One's corporate bonds, one's government bonds, but there hasn't really been a lot to differentiate between those two. You can see they've just about ticked up for the year to date. What I would highlight, as we talked about at the previous session, in the rebalance one prior, we did actually increase our exposure to government bonds, particularly the duration, which adds a little bit more to the interest rate sensitivity. And since we made that increase, you can see bonds have actually fared pretty well overall. So that's the broad market backdrop. But what I might do just on the next two slides before I hand over, I'll talk a little bit more about equity markets, because I think when you just look at that developed market equity line that's made 12%, it doesn't give you the full picture of what's happening underneath. So we'll sort of dive into two levels deeper. So on the next slide, I'll just look at this by region. So the dark blue line there becomes the dotted blue line on this chart. And disaggregating that, you can see the US continues to lead the way. It is a US tech story that I'll talk about momentarily, but US equities continue to power ahead and really leaving other markets somewhat behind in their wake. UK, you can see, is doing quite well. It's gained 10% this year. Most other markets, be that Japan, emerging markets in Europe, still pretty decent. But hanging back at that mid single digit gain. So 5 and 6% more broadly. The UK doing a little bit better, but it's the US that is leading the way. And if I disaggregate that further on the next slide, I think it's important to talk about what's happening in the US equity market. We have talked about it previously, but just to sort of reiterate, it is only a handful of names that are driving US stocks. We've talked before about the Magnificent Seven, these large US tech stocks. It's only really one, two, arguably three. It's Nvidia. It's the chip maker that makes the chips that people need for AI that really has stormed ahead. Microsoft also gaining, as has sort of Meta, which is the owner of Facebook. But if you take that effect, so you can see there, the Magnificent Seven, you can see how well those particular seven largest technology stocks have done. They're up 32% so far this year. If you look at US equities overall, you can see that 14%. But actually, one way we can look at these things, and we have talked about before, instead of weighting it by the size of the company, which means that these tech names dominate, if you just equally weight the US index, so this just tells you how the typical company in the US has performed, you can see it's actually only up 8%. And that 8% shows the average performance of the US equity. That's actually in line with what we saw a couple of slides ago. Most companies globally have done mid to high single digit returns this year. It's just the impact of the Magnificent Seven that is distorting some of those indices. And you can see in the last few weeks, after a very strong year, they have fallen back quite notably in a short period of time. Now they've had a huge gain to fall back on. So they've gone from about 40% down to 32%. But we're seeing a little bit of undulation in there. There's a few things driving that. Expectations are already extremely high for these companies. We saw in the last couple of days, Microsoft growth of about 19%, which is very high in and of itself. wasn't quite what markets expected. So there's a little bit of disappointment there. Even with good news, it's fallen slightly short of those expectations. At the same time, in the US, touching on politics already, but JD Vance, who is going to be Donald Trump's running mate for the Republican Party, he is considered at the moment to be quite hostile to many technology companies. Some of the tariffs he wants to impose as well would potentially cause harm to some of those technology names. So that's already started to feed into some of the market thinking. And at the same time as the Magnificent Seven is falling, smaller companies are benefiting from the expected fall in interest rates. And small cap in particular, and we're seeing a lot in the US, smaller companies tend to have a lot of bank debt that tends to be floating rates. So the current interest rate is what they have to pay rather than being able to lock in more preferential terms. We're seeing that positivity come through within the US market. So a little bit of a rotation. It's unclear whether or not this is the start of a sustained fall or whether or not it's a blip. But I would just caution it is a very brave individual that tries to bet against US technology stocks, particularly when they are having these very strong earnings growths coming through. The question is really, what valuation do you want to put on that strong earnings growth? So that provides a little bit of a market backdrop. On the next slide is where we move over to the economic situation. And there, if George is now online, I'll hand over to you, George. Are you there, George?
Yeah.
There you go.
Hear me? Can you hear me?
You're breaking up a little bit. Do you want to give it a second and try again?
Oh, give me, yeah.
George, can't really hear you. Okay. I can't hear you, George. So, how about if you want to try and restart, I won't try and do an accent, but I will attempt to cover your economic section while you come back on. So if we go to the next slide, please, Zach, thank you very much. I think there's a couple of things we're looking at in terms of economic activity. So there are two important things here. On the left-hand side, this shows the global economic indices. This shows how economies are doing in general, and you can see they're still underperforming. As we've seen extremely tight monetary policy, that's started to come through. Some of the economic indicators have become subdued. You can see that dipping over the last couple of years and then moving sideways. But actually, despite that, what you're seeing is that leveling out. And that's important because what that shows us, and this is what's enabling some of the interest rate cuts to come through, strong economic activity in 21 and 22 led to inflation. That caused central banks to start tightening policy in an effort to bring that under control. And since then, we're seeing a leveling off. And the important question for us is...
Sorry, Ben, I'm back. Can you hear me?
Yes, I can hear you and see you perfectly. So
Sorry about that. Sorry about that. Yeah.
I was just talking about the chart on the left and showing economic activity has cooled in response to tight central banks and it's leveling off. And then I was about to talk about PMI expansion, but I'll let you take over now.
Thank you, and apologies for the technical glitch. And before I start, I have to say that the day today is a little bit unique in the sense that we haven't seen such geopolitical turmoil in quite a few months as we have today. And oil hasn't picked up yet, but whatever we say in terms of the economy always hinges on some sort of geopolitical stability. And today the day is anything but. So I'll give you the broad picture, but the backdrop of this is a volatile one. Okay, and just bear in mind. So as Ben told you, on the left-hand side, you can see our key economic indices. Anything below zero suggests that they are far worse than average. So that is across all major regions, with the UK being the one that significantly underperforms. On the right-hand side, you can see that the so-called PMI indices, which are forward-looking indicators for services and manufacturing, at least they are expanding. So anything above the red is expansion, anything below the red is contraction. So we are at a point, I would say, all other things being equal, a sort of sweet point in the global economy. Things are not doing that bad. There is a disconnect, of course, much like stocks, between the US and the rest of the world. So let's take the US. In the US, the economy is growing at a very healthy pace, but not at the breakneck pace that would force the central bank to hike rates. In fact, we think that there is a good chance that we'll see rate cuts this year out of the Fed. So the economy is sort of in that sweet spot where it's growing enough, but not fast enough to cause the Fed to further tighten the supply of money. And that's a that's a very nice place to be. Next slide, Zach, please. Now, yes, of course, on the one hand, it's growing. On the other hand, we are looking at the forward-looking indicator, which is the services PMIs. And the last month, the services PMIs dropped significantly, almost across the board, really. So that is the other question. The global economy, developed economy, is about 70% services. If they all slow down, are we looking at the, are we still in the slowdown phase of the global economy? And the answer is the data is a bit jumpy. And there is a disconnect between the US and the rest of the world. But yes, we are growing, especially the US, at a healthy pace, but the trajectory is still slowing. And especially, if you see that chart across all the services, does give rise to some thinking as to economic growth. But it's great news if you're a portfolio holder and you really want central banks to reduce the cost of money and hopefully spare a risk asset rally after that. Next slide, please. Now, again, we see that disconnect we talked about, and Ben talked to you about that disconnect in the first part of his speech. The same thing that you see in equity, you see in the economies, you see in consumers. The blue line is the US consumer, and the other two lines are the EU and the UK. And these are retail sales year on year. So US consumers are outspending. In the EU and the UK, where growth is barely positive, people are not spending so much. So that disconnect is there. By the way, why is the disconnect an issue? It is because the US opted to sustain a little bit higher inflation in order to spur growth, in order for the incumbent government to beat Donald Trump in the election. So they said, we're going to do it with growth. It's an election year, and you don't win elections with fiscal austerity. And if even the balance, you have an inflation which is, by the way, slowing to around 3%, and you don't think you have major risks, then you can afford a little bit more growth to keep voters happy. And this is pretty much what is happening. The EU does not have the fiscal space to do that. Remember, they have the Stability Pact, and in the UK, sorry about that. And in the UK, things are a little bit worse because there is less fiscal space, and generally the economy has been under delivering for quite some time. Next slide, please. The overall, and again, that's the upside again. The economists are feeling a little bit more optimistic going forward. So these are projections for the end of 2024 by Bloomberg, which means they aggregate a few hundred banks and their projections. We also contribute to those specific projections. And as you can see in the last 3 months, that is your right-hand bar, things have improved, not just for the US, but really for the EU and the UK. So economists now think that growth will pick up by the end of the year in Europe as well. And fears for a recession in 2023 and 2024 have significantly subsided. Yes, technically the UK went through a quarter of recession, but that was just very, very south of zero, and growth picked up again. So, in the US, things are good. In Europe and the UK, things are north of zero, but sort of improving. Okay. So this is an environment where central banks can consider cutting rates. Okay, all other things being equal. Now we're going to talk a little bit about the all other things being equal because the devil is in the details. Next slide, please. As of the end of last week, and apologies, this is an indicator that jumps around a lot. Markets were pricing in nearly 3 rate cuts in the US, 2 in the UK, and 2 more in the EU. Our collective house view is a little bit more pessimistic than that. We feel that personally, I'd be happy with two rate cuts in the US. I think is still at the top of my expectation. Between one is also something that I would accept. So I think the market is again a little bit on the optimistic side. Remember, in December, markets were projecting 7 cuts across the board. Okay, and except for one cut we saw in the EU, we haven't seen anything yet, and we are in August. So in terms of what markets are projecting, we think they're again a little bit on the optimistic side, and that's certainly reflected in bond prices. Next slide, please. Now, there is a question that keeps coming up. The EU and Europe and the UK, the economy is not doing so well. So why not just cut rates altogether? So this is a chart which shows what can happen in terms of foreign direct flows if you have a very big differential with a greenback. It's not really that as technical as it might sound. So the light blue line is the Chinese 1-year interest rate versus the Fed rate, and the thick blue line is foreign direct investments in China. So when China lowered interest rates a lot, money left China and it went to US accounts because they were yielding a lot more. So the EU interest rate is already 1% below the US. If it goes another 1%, Ms. Lagarde could be faced with a lot of cash outflows, even destabilizing ones. It's the same thing for the UK. The UK has a lot of foreign investors. If they feel they can get a much better deal in US accounts, they will do so. So if you're wondering why Andrew Bailey is not lowering interest rates despite the significantly worse economic outlook in the UK than the US, look no further than this chart. And that tells you all you need to know, that although the economies are sort of in a different part of the cycle, and the US is definitely more growthy, still the ECB and the Bank of England are dependent on the Fed before they can embark on a proper rate cut cycle. Now, I know the ECB has cut once and may also do another one, but it's going to do very little versus what might have wanted to do unless the Fed starts moving. And that is, the reality in the modern global monetary system is that everybody, especially in economies that are so joint, Western economies, everybody's waiting on the Fed, which is why a large part, of course, of our presentation really revolves around America. Next slide, please. Now, inflation has come down. On the left-hand side, you can see core inflation coming down, which means, if you exclude the energy part, which is the volatile one, i.e., if oil jumps up this morning because of the news in the Middle East and Russia's attack on Kiev, that would not show up in this index, at least not for 2 or 3 months. However, the reason it's been coming down is mostly China. So what China has been doing is it lost a lot of market share in the past few years, and then it cranked up production. It now has a lot of capacity to spare, which means it can export goods at very low prices. So what we're seeing in the West is deflation, but on the good side. So on the right-hand side, which I think is the most important key takeaway from my part of the presentation, at least, you see the US, the UK, and the EU. The blue lines are where goods inflation is, and the little dot above it is where goods inflation is on average for the past 30 years. The green lines, the green bars, is where services inflation is, and the dot is its own average. So that means that goods inflation is running way below average, and services inflation is running way above average. Now, China is reaching a point where it cannot just dump goods in Europe and the US because developed countries are reacting, and they fear long-term trade repercussions. So they might, and they have been imposing tariffs, which are inflationary, and they should stop that disinflation coming from goods. And by the way, China can only do this for so long. It's going to destock, and then it's going to need to restock, and they cannot keep dumping goods at very low prices in other developed markets for very long. So this strategy, anyways, is not very long-termish, which means that we're not done with inflation, because services inflation, the sticky part, is still way up. In the US and the UK, it's over 5%. And as we said, services are 70% of the economy. Okay, so we're not done with inflation. And that is the other thing the central banks, all of them, including the Fed, are seeing. And that is why our projection, yes, interest rates might start slowly to come down, but we're looking into a volatile 12 months in terms of macroeconomics and geopolitics and all that. And on top of it, we don't think the process will be smooth. So the chart on the left-hand side might seem a bit smooth, and you might look at it and say, okay, yeah, well, we're going back to the previous inflation regime. Actually, the underlying numbers tell us that we need to be cautious, and we're pretty sure that the central banks are looking at the same set of numbers. Next slide, please. In the US, there is another gauge we are looking at, and that is because all of the Fed members have pointed to it. It's house prices remaining elevated. House prices are elevated across the board, US, UK, EU. The housing market has really been doing much better than anticipated. Of course, we didn't have a recession, but still, real assets have been doing very well. So that's the other key indicator for the Fed, and it is elevated. It is prices are at 7.2%, almost 2% above their own average US house prices. Next slide, please. Now, the other indicator, and I want to talk a little bit about that, and then I think we can start the process of handing over back to Ben in the Q&A, is the yield curve. So what is the yield curve? It's a differential between the 2-year bond and the 10-year bond in the US. Okay, you take the 2-year yield and you take the 10-year yield and you subtract the 2-year yield from that. Now, normally, when I lend money to Ben, say £1,000, if I lend money to Ben for 2 years, I'm going to require an interest rate, say 3%. And if Ben tells me, George, I want you to lend me money for 10 years, Normally, I would require a bigger interest rate because he's going to keep my money for an extra 8 years. So if I was happy to give him my money for 3% for 2 years, I'll probably ask for a 4 or 5% for 10 years, and that is what we call a normal yield curve. Over the long term, the interest rate should be higher. Now, for the past 2 years, the opposite has been happening. Ben was charged a higher rate for borrowing money short term than he would long term. Now, this is normal when you have interest rates going up. Okay, some part of yield curve inversion, as absurd as the notion is, happens and has to do with the mechanics of higher interest rates of the shorter term. The longer term takes longer to move. But what is uncommon is that these things usually last a year tops. Okay, so that's 220 and 55 days tops. Okay, these were most of the incidents we've had in the since the 1980s. Presently, we're seeing 535 working days, nearly 2 years of yield curve inversion, where short-term rates are higher than long-term rates. And by the way, the curve should have disinverted and gone back to normal the moment we figured out that rate cuts are coming. So why is the yield curve disinverted, and what does this mean? First of all, yield curve inversion is the one key indicator markets are looking at when they're trying to figure out whether we'll see a recession or not. This has always been the number one indicator. So the fact that we have had 2 years of yield curve inversion without a recession tells us one thing, that interest rates in the US are probably appropriate. I.e., at 5.5%, the Fed for the US economy, that interest rate, and given the growth, the economic growth, is not an inappropriate interest rate, which also tells us that unless we have a financial accident, we are not likely to see steep rate cuts like we have seen in the past. In terms of the BOE, the Bank of England, and the ECB, this means that as they follow the Fed, they have no other choice other than to follow it down in a paced way. Okay, and these are sometimes the pitfalls of the America First economy, in the sense that now the world, well, Europe has higher rates than probably it should to spur its own growth, but there is very little can do about it, lest it risks capital flight. Next slide, please. And oh yeah, elections. So I'll touch upon this very briefly. This is after Ms. Le Pen won the election, because she got 30% of the vote, but she came in third because of the electoral system. A sort of left government is being formed. Now, they're still deliberating and all that, but what we see in terms of the French spreads with Germany is that markets are almost as worried about the left government as they were worried when the elections were first called, and it seemed like Ms. Le Pen would be a shoo-in to win. So the markets are not happy either with the right or with the left. Markets generally prefer centrist policies. Okay, and in France, this is going to be very difficult to deliver. Next slide, please. Now, France, before the whole thing began, and I suspect it has, there is a reasoning why Mr. Macron called an early election, was already deep into a deficit. In fact, it was not going to get up its deficit below the 3% threshold before 2027. So France doesn't have much fiscal space. Debt to GDP is running at over 110%, which means that Mr. Macron now has some very difficult choices to make. And the left government, which wants, much more fiscal expansion, might find difficult to deliver that. So what I see is uncertainty out of France, certainly. And to quote The Economist, a giant Germany-shaped void at the heart of Europe. Germany is not willing to step up once more to assume leadership of Europe. So that could mean in the next few months we could see some mixed messages from Europe and possibly lackluster growth as a result of um, uh, anti-cyclical policies, i.e., policies which are not fiscally expansionary because of the 3% deficit straitjacket that the EU imposes to keep the Eurozone going. Next slide, please. So this is a world, and just focus on the left-hand chart. This is a world where we owe a lot of money. Everybody owes a lot of money. Now even China owes a lot of money. 10 years ago, it owed 54, 57% of GDP, and there was a lot of internal debt already in that. Now it owes 100. It will be about 110% by the end of the decade. In the UK, that's the number that we also expect near the end of the decade. Near the end of the decade, 110%. So this is Labour's conundrum. They told us a few days ago that there is a giant deficit, around 20 billion in terms of government funding, which is going to make it difficult for them to enact many of their pro-growth programs. And this was somewhat to be expected. The debt is what it is, and when Liz Truss tried to ignore it and enact a very expansive budget, she was thrown out of government in less than 2 weeks following the mini budget. So Labour can't take that chance, which means also, given what we heard a few days ago, that we don't expect Labour to give a major kick in UK growth. UK growth might come from global cyclical factors. It might come from being close to the US economy. It might come from other factors, but I do not think that where it is the government can, fiscally at least, can provide meaningful fiscal expansion. And I think they told us as much. So changes for growth are going to have to be slow. They're going to have to be, dealing with bureaucracy, dealing with trade and all that, which takes a lot longer to pass through the real economy. Possibly the best source of growth right now is lower interest rates, but again, we have to wait for the Fed to move. So a lot of the fate of the UK economy lies outside of it, and that is a message I think that is pertinent. And with that, I think I can pass the mic back to Ben.
Thank you very much, George. A very comprehensive coverage of the economic backdrop and easing us into elections, which is certainly going to be very much in focus for the next few months, both the new governments we have and governments we may have in areas such as the US in the future. So that covers markets and economics. I thought I would just sort of wrap up by talking through the portfolios themselves, our asset allocation, and some of the changes that we've made. In particular, the asset allocation change that we made the latest quarter, so the rebounces took place at the beginning of July. One of the key asset allocation changes we made, we've increased our US exposure. We've increased our Japan equity exposure, and at the cost of reducing a little bit of the US. So I'll talk about the rationale primarily for Japan. There's several reasons that we're positive. Starting point, the market itself looks pretty cheap, and this chart I think we've shown before. This shows different regions of the world equity market, and it shows anything that's above the line is expensive, anything that's below is cheap. And this looks at a price to earnings ratio. This is a very commonly used valuation measure that we've talked about before. This is forward price to earnings, so earnings expectations versus the price. And this shows where the current valuation is versus its average over the last 30 years. You can see in particular, the US is looking expensive. As we talked about at the start, expectations in the US are very high. So simply hitting those high expectations is not going to be enough to push markets forward. Most other markets, as a result, are cheap. You can see there, Japan is trading at a 20% discount. So that valuation looks quite attractive to us. Of course, it's not just about valuation. There do need to be other reasons to buy as well. So if we look on the next slide, we can talk a little bit more about some of the fundamentals. The Japanese economy has been in a malaise for a multi-decade period. The chart on screen at the moment goes all the way back to 1979. And there's lots of different lines on here. What I would point to, though, is looking at wage growth and looking at particularly the red line, that's wage negotiations. A lot of wages in Japan are organized collectively. And what you can see over the last sort of 30 odd years, effectively, wages have gone nowhere. Japan as an economy has really stagnated. It's had poor inflation. It's really struggled to achieve any form of growth. And there's been several lost decades in Japan, but we're starting to see things turn around. This chart shows that significant uptick in wage expectations. You can see inflation, which is the dark blue line, has picked up and appears to be sustainably stronger. We see other factors as well. You'll have seen overnight the Bank of Japan has increased interest rates. They're now at 0.25%, which doesn't sound like a lot, but bearing in mind, well before it was done in other developed market economies, particularly in the West, Japan has had a zero interest rate policy or negative interest rate policy since well before COVID. Arguably before it wasn't really a factor in the global financial crisis. Japan's been in so many decades of struggling to achieve economic growth that it's had interest rates going nowhere. The fact that the central bank now feels able to normalize those interest rates, it's increased them, it's cut back on its bond buying program. At the same time, we're seeing an uptick in domestic economic activity. It does seem that post-COVID, Japan has finally been able to shake off the problems it's had with low growth, low inflation, and may well be turning a corner. So the economic domestic situation is starting to materially improve. As well as that, we also have on the next slide other catalysts for improvement. Japan for a long time has traded at a bit of a discount. It's had complex corporate structures that don't necessarily help minority shareholders. There's been a lot of sort of cross holdings and corporate cultures that aren't conducive to significant foreign ownership. That's starting to change. There's a huge amount of corporate reform happening in Japan. Just on this takes an index of Japanese equities. The Tokyo Stock Exchange is pushing companies that are currently trading at a discount to their book value to get it to 1 or above. What does that mean? The book value is effectively, if you take a company, sold everything off, that's the value of its tangible assets. So in a sense, any company that trades below book value, you could just sell off the constituent parts and you get more money than it's worth. It's very unusual to have a company trading at less than its tangible value. But that's what's happened for a number of years, and that's because the odd corporate setups they have, the odd corporate cultures and cross holdings, means that foreign investors wanted a discount to reflect that unusual situation. As that's starting to change, this improvement in corporate culture we're seeing broadly making corporations more friendly to minority investors and international investors is a significant catalyst. And still a third of a major Japanese index is trading just below that, and we're seeing continued improvement. So that just gives you 3 different ideas. If we go on to the next slide, that then leads us on to the changes that we made this quarter. I've talked about that increase in Japan. Valuations are attractive. They're improving fundamentals in Japan. There's catalysts for change as we're seeing improvements to the corporate culture. And as a kicker, we've touched on a little bit the potential of increased trade tensions between the US and its allies and China. Japan could well benefit from any increased tensions there. So several reasons to be positive on Japan. And against that, as we've talked about periodically, the US, you're just not systematically being rewarded for taking much risk. Valuations are high. It's a bit difficult to justify those high valuations. So we've taken a little bit of profit from the US to move it into Japan. We've also made 2 fund switches. I won't dwell on those now. They're not particularly substantial, but they do improve the effectively quality of the portfolios. And there are some fund specific reasons we wanted to change these two, though nothing fundamentally wrong with those funds that are in. So in the interest of time, I won't dwell on those. What I will point to is the next slide. If you are already in these portfolios, we now produce a quarterly rebalance note. So this shows the changes that we've made to all of the model portfolios. It does have a little bit more explanation of the reason for those changes. So if you are an existing portfolio holder, these are only for existing service users, given the nature of the publication. But if you haven't already received that and would be interested, please do get in contact with your usual representative here at Forvis Mazars, and we can send that along. And you can just see on the right-hand side, taking the balanced portfolio as a representative example, you can see the size of the move. So Dodge and Cox is the US value fund that we've reduced. And you can see that M&G Japan line is where we've increased that exposure. We've also consolidated the Japan exposure into a single fund, a very high quality fund, I might add. So that just gives you some sense of the magnitude of that change. Then I think the next slide is really the last one that I have to talk about. I think it's always useful to try and show to you where we are, where our tactical positions are. So this just shows where our tactical tilts are compared to where our strategic exposure may be. We tend to look at asset classes in two different ways. One is what the asset class actually is. So, for example, UK equity or investment grade corporate bonds or precious metals at the bottom. I also want to introduce this webinar. We'll talk about it more in subsequent webinars, but the style we talked about what their function is in a portfolio. And within a portfolio, we look to some areas, particularly equities, to be the big growth driver that tends to come with the most risk. We also look for some diversified exposures that are there to try and provide diversification benefits. And then we look for some elements of the portfolio really to be a little bit more defensive and try and offset potential risks in the event of downturns. But what you can see all the way on the right hand side, you can see where our tactical positioning is with that latest move out of North America. That puts us effectively underweight, so less than we strategically would have in the US, particularly no dedicated small cap exposure and less in value. We continue to have a broadly neutral exposure to growth assets. And in place, as we said, we've added to Japan. So we're now overweight Japan. We've also got a little bit of an overweight still to the emerging market and Asia Pacific regions. And we have this overweight to energy equity that I talked about before. But hopefully this gives you a snapshot of how the portfolio is positioned. If we go on to the next slide, we can move quickly towards the Q&A. I include this every time. This is just a topical cheat sheet. Lots of things happening in the world. There's AI, there's oil prices. We touched on elections and geopolitics. We do think about these deeply and we think about them a lot, but quite often they are simmering in the background rather than presented today. But this just gives you sort of one-liners or couple of liners on some of the big events as they're coming through. So if we go to the next slide, please, Zach, this will just move us on to the Q&A, and I will start bouncing around some of these. A couple have been submitted live. So George, if you want to come back on camera, I will push some of these to you. One that we had, actually one in advance, we did touch on it a little bit, but could you perhaps talk about, let's talk about the US for a start and elections there. The question is, have we considered what might happen to financial markets if Trump gets re-elected? Also, if he removes the US from NATO, what impact would that have, and what are our thoughts in that space?
So initially, I don't expect a negative reaction from financial markets if Mr. Trump gets elected, at least nothing of any magnitude. In his previous stint, the S&P 500 rose by 33%, and that should be enough for financial markets to at least be calm. Also, it's going to depend a lot on whether he will have control, whether Republicans will have control of both houses of Congress. And that trifecta is at this point is not the likely scenario that Republicans will control the White House, the Senate, and the House. By the way, the House of Representatives controls the budget, so that's its importance. The Senate controls appointments and foreign policy and all that, and the president, if he doesn't have Congress with him, his effect is mostly outside the US in terms of foreign policy and the military, and less internally. That's how it works. So markets are going to wait to see what the government looks like rather than whether Mr. Trump gets elected. Ben, and now if he takes the US out of NATO, I'm not sure how to respond to that. That is a singularity. I mean, imagining NATO without the US is, to use this organization, it's Europe essentially. I mean, this would force Europe to definitely unite in a military way. It would put the UK in a terrible bind because it will have to pick between its east and its west. Or it can just try to remain independent, but that might not be the best strategy. So I'm not sure how to answer that last one. It is a singularity if Mr. Trump just dissolves NATO. Would markets react to such a big geopolitical event? I'm sure they would, and I'm sure it's going to be a negative reaction, but I'm not sure it's going to happen in the same day. The effects of this could be very, very long term.
Great. Thank you very much, George. A couple of questions that have come in. I might pick these up. And unfortunately the answer is effectively I don't know. But the first one is what do we expect to happen to house prices in the next few months? A few months time frame is very hard to call, and residential property isn't something we particularly focus on in markets and investments, simply because it tends not to be a broadly investable asset class, and the dynamics at play, home ownership, don't necessarily tie in with the broader investment driver landscape. What I would say, house prices are still relatively high. They did have a little bit of a blip, but continue to move higher even as interest rates moved up. Normally, when interest rates go up, you expect house prices to fall because mortgage costs become more onerous. What people can afford is lower. But I think there is a risk as interest rates have gone up and house prices have been allowed to drift higher. One of the areas we're seeing is as interest rates come down, you might see a little bit of downward pressure on house prices, simply because, and this is certainly what one of the ideas we've seen in the US and is true to an extent over here as well. When you have interest rates move up very sharply and very quickly, rather than people being able to afford less and less, you have a lot of people on very low interest rate mortgages unwilling to move house because the jump to take out a new mortgage from 1 or 2% up to 5, 6, 7% is so high, it can cause a bit of a freezing of the market. So a lot of people that have mortgages are unwilling to remortgage and get a new house. So you see the housing market start to free up. What we may see as interest rates come down, and I saw in the news you can get a 5-year fixed rate mortgage now for less than 4%. These had been sort of mid 4.x, almost 5, and slightly higher in places. As they start to move a little bit further down, you might see the housing market start to ease up, but that might come in lockstep with house prices drifting slightly lower, because normally they would have drifted lower as interest rates have gone up. Because there's been this freezing effect, as the market loosens, you might see a little bit of trimming of prices just to allow that market to start to move. You've also got to bear in mind that Labour has announced, that the new Labour government has announced plans to increase housing supply quite significantly. This the highest forced target numbers since sort of the 60s and 70s. So that may have an impact in the short term, but I don't think it's going to be a dramatic sell-off. I think you might just see what would have happened over the last couple of years if the market had been a little bit more dynamic and mobile. That probably leads me on to the next question I'll bounce to George, which is, George, what do you think that the impact of a Labour government is going to be?
Well, I think we talked a little bit about this during the presentation. I think that, and pardon the parallel here because I know it might annoy some people, but there are some echoes of this. So back in 15 years ago in Greece, a socialist government was elected, the same thing as the Labour Party, with promises that they would deliver better growth. And when they came in, they discovered a very big deficit, and they said, "Well, we can deliver what we said." Now, in the case of Greece, it was the incident that led to the famous collapse, and obviously the UK is nowhere near there. But I think that given what we heard in the last few days, I don't think the Labour government will manage to have a major impact on growth, at least over the next year or so, because to get quick results, you need fiscal expansion, and we do not have this. We cannot have this with the fiscal situation as tight as it is right now. So I think at best, the Labour government, if they do a great job at everything else, they can improve some trade ties with Europe. They can make sure some investments are unlocked, but that means growth over the next 2 to 3 years rather than growth over the next 6 months. I don't know, Ben, would you disagree with that statement?
No, I think that's entirely valid, and the key point is that the Labour government has gone to pains to not spook markets and not spook business, and that's been their overriding message. So,
And I have to say, in that respect, given how I saw things going 15 years ago, in that respect, they have managed very well. They have managed this message in a way because, I was afraid of the market reaction. They've managed the message in a way that gave traders ample time to prepare. And of course, the United Kingdom is not Greece, but still, they have managed it very well. And that's something else we can observe, is that the government is going to be sensitive to markets, which is not bad for those who own UK risk assets.
absolutely. Thank you, George. There's a couple of linked questions, so I'll answer them at the same time. And again, it's a don't really know, watch this space. But there's and a lot of relates around potential changes to taxation arrangements. So one is what we think the government's pension reforms are likely to cover is the 25% tax-free cash lump sum under threat, and then a possible rise in taxes for inheritance, investment, and pension. How will that affect us? Again, this is one that our financial planning colleagues are looking into very actively. The reality is there's not a lot of information available at the moment. I think what has been made clear by the government, and Rachel Reeves in particular earlier this week in her presentation around this black hole, this £22 billion black hole in the government finances. What was important there, we knew a big number was coming. That is laying the groundwork to potentially cut spending and or raise taxes. And in the same presentation or same speech, Rachel Reeves reiterated they don't intend to increase national insurance, income tax, or corporation tax. So all of those sort of working taxes, which leaves not a huge number of places for the government to go. There is this sense that wealth is back on the table, and I think they're laying the groundwork for some difficult decisions later in the year. How those will land, it's not clear, and certainly our financial planning team are looking very much into that. So I'm afraid I don't have any answers now, but I think the Treasury will be looking very widely at what can be achieved, and as soon as we have a little bit more detail to go on, we'll be scouring releases and picking up the various bits of intelligence we can, and we will give you more information on that, particularly when our financial planning colleagues are able to publish something on that. The one thing I would add on pension reforms, as well as taxation levels, wrapped in is a drive by the government to try and improve. There's a big move to try and improve UK company listings and UK businesses in general. So alongside that may come more incentives to put money into UK companies. So it's not just going to be about potential penalties or or changes to regimes, it could be trying to drive that incentive. Remember, the government has a growth agenda for UK businesses that hasn't been clearly articulated yet, and there is a task force looking at that investment strategy. So that may get wrapped in as well, but it is a little bit of a watch this space. And we've got 3 minutes left, so time for one more question, which we have. It's around Japan, but George, I might bounce this to you to make sure we're equitable with the questions. It does say, with regard to the Japan share prices being below balance sheet value, so this price to book measure we looked at earlier, maybe the balance sheets are overstated because loss-making operations have not been fully written down yet. I've got some thoughts on this, but I don't want to dominate all the questions. So George, let you go
no,
first.
actually, I'll let you take that because you've done the
Okay,
legwork on Japan, so I'm
cool.
happy for you to do that.
Yeah, I think it's entirely possible that some elements, loss-making operations, haven't been written down. But what I would say, you would expect any business to be worth at least the value of all the assets if you sell it, and they should be trading at a premium. In the US, you get sort of 2-3 times book value quite easily, because the book value is just the value of your assets, and you should expect some quite considerable price to incorporate how much money can this business make in the future. So I think even if you wrote down the balance sheet, the idea that you would write down so much of that balance sheet that you get to a positive number, that will be an awful lot of loss-making operations. Now, you're exactly right that Japan does have a tendency to keep hold of workers and poorly performing operations longer. They're much more, it's just ingrained in the way the Japanese economy operates. They're more likely to holding on to loss-making businesses longer to try and improve them. If you look at the US, it's more cutthroat. They're very quick to cut loss-making divisions and reinvest those assets. UK and Europe tends to be in the middle. So there's likely to be some loss-making operations that need writing down. But Japan overall, particularly the Japanese equity market, a lot of privately owned businesses probably suffer from that more. In the public space, we have a lot more visibility. So I don't think, I think it certainly is a factor, but that should be why book values are not 2 times or 1.5 times. They should still be at a premium, even accounting for some of that write down. And I think it's this holding structure that people apply a discount, and as that gets resolved and that corporate culture increases, we should see those numbers materially above 1, because that's a typical environment for a market environment. Wonderful. There's no more outstanding questions, and we only have a minute left. So it just leaves me to thank George for speaking today. I thought it was very insightful. Thank you to all of you for listening and for your questions. If you do have any follow-ups, please do reach out to your normal contact here at Forvis Mazars. And I hope to see you again on the next webinar.